Investing in the stock market can feel like you're trying to understand quantum physics. You hear about markets going up and down and people making thousands of dollars in one day and losing it all the next. Naturally, you're left thinking, this is way too risky for me and I'll just leave my money in the bank and call it a day. While I totally understand where you're coming from with the first part, the second part, that's where you could be silently losing money. Let me explain. Leaving your money in the bank might feel safe, but inflation, that sneaky little thief, gradually erodes your purchasing power. And don't forget about the opportunity cost, the potential gains you miss out on by not investing your money. But hey, let's not complicate things. And you know what else isn't complicated? Subscribing to my channel. Just hit the subscribe button. It's quick, painless, and best of all, it's free. And who knows, you might just stumble across videos that can help you make sense of this wild financial world. Seriously guys, subscribing is easier than deciding between the coffee brands at Walmart. Now back to the topic, why investing isn't as complicated as it seems. Contrary to what social media might have you believe, investing doesn't have to be overwhelming. You don't need to be a financial wizard picking individual stocks, analyzing endless charts, or worrying about whether some company is on the brink of bankruptcy. That's where mutual funds, index funds, and ETFs come in to save the day for you. But before we dive into these, let's tackle a fundamental concept, market index. What is a market index? A market index measures the performance of a group of stocks, bonds, or other investments. Think of it as a report card for the stock market. One of the most well-known indexes is the S&P 500, which tracks the top 500 US companies listed on the stock market. When someone says the stock market is up by 30% this year, they are usually talking about this index. Funds like the ones we're about to discuss either try to match the performance of these indexes or beat them. So let's break down the different types of funds. Let's start with the OG of investment vehicles, mutual funds. Chances are you have heard about this term thrown around before, even if you're not sure exactly what it means. So let's break it down. A mutual fund is essentially a big pool of money collected from many investors. This money is then managed by a team of financial professionals whose sole job is to decide where to invest it. They actively pick, buy, and sell stocks or sometimes bonds in an attempt to generate the highest returns possible. Their goal is to beat the fund's benchmark index, a standard that they measure their performance against, just like the S&P 500. This style of investing is known as active investing, and the funds themselves are often referred to as actively managed funds. Sounds fancy, right? But here's where the things get a little interesting and a bit pricey. Management fees and cost. Because real breathing humans are doing the heavy lifting, like researching companies, analyzing financial reports, and executing trades, you have to pay for their expertise. These fees, also known as expense ratio, usually range between 1 to 2% of your investment per year. Now 1% might not seem like much, but over decades, it's like a slow leak in a tire. It can quietly drain a significant chunks of your returns. To put it in perspective, on a $10,000 investment, 1% means paying $100 per year just in fees, regardless of whether the fund makes money or not. And in today's world where there are lower cost options available, anything over 0.5% should make you side-eye the fund manager. And here's more. Despite all their efforts and fancy degrees, most actively managed funds fail to outperform their benchmark index over the long term. The very index they are trying to beat often ends up leaving them in the dust. Why? Markets are unpredictable and even the pros can't consistently time the market or pick winners. Now, I can't keep talking bad about them because despite their drawbacks, mutual funds do have some perks. Number one is hands-off approach. Once you invest, the fund manager takes care of everything for you. No need to stress about picking individual stocks. Number two is diversification. Mutual funds typically invest in dozens or even hundreds of stocks, spreading your risk across multiple companies and industries. Number three is variety. There is a mutual fund for almost every type of investor, whether you're looking for aggressive growth, steady income, or socially responsible investments. However, with their higher fees and questionable ability to outperform the market, more and more investors are ditching mutual funds in favor of passive investing options like index funds and ETFs. I mean, why pay more for less, right? So let's talk about the next one, index funds, the smarter, more budget-friendly cousin of mutual funds. These are the go-to options for people who want to invest in the market without all the drama of stock picking or the hefty fees of actively managed funds. So what are index funds? Index funds are designed to track the performance of a specific market index like S&P 500, the Dow Jones Industrial Average, or even international markets. Think of it like this. Imagine the S&P 500 as a playlist of the top 500 most popular songs in the US. An S&P 500 index fund is like the copy of that playlist, but instead of music, it's filled with the top 500 stocks. It doesn't add or remove anything. It's just the same greatest hits, but in the world of investing. For example, when you invest in an S&P 500 index fund, you're essentially investing in all the companies in the S&P 500. Big names like Apple, Microsoft, and Amazon are in there along with hundreds of other giants. The idea is very simple. Instead of trying to guess which company will win, well, why not try to invest in the entire league? So why are index funds popular? One word, simplicity. Okay, maybe two words, simplicity and cost. Unlike mutual funds, index funds don't have highly paid fund managers actively picking and trading stocks. Instead, they are run on autopilot, aiming to mimic the index that they follow. This means A, lower fees. Since no one is actively managing these funds, the expense ratios are usually below 0.1%. Yes, you read that right. To put it in perspective, on a $10,000 investment, a 0.1% means you're only paying $10 per year in fees. B, consistent performance. They don't try to beat the market. They just aim to match its return. And over the long term, the market tends to perform well, historically around 7 to 8% average annual return after adjusting for inflation. So don't use inflation as an excuse to future wealth. Examples of popular S&P 500 index funds. If you're ready to dive in, here are a couple of fan favorites in the index fund world. Fidelity 500 Index Fund, ticker symbol FXAIX. Vanguard 500 Index Fund, Admiral Shares, VFIAX. Both of these funds do the exact same thing, which is to track the S&P 500. The main difference lies in the companies offering them and the tiny variations in their fees, but performance-wise, they are practically identical. One of the best features of index funds is automatic diversifications they offer. As I mentioned, an index fund spreads your investment across hundreds of companies instead of putting all your eggs in one basket or one stock. And the fund's allocations are based on market cap, meaning larger companies like Apple, Nvidia, Microsoft take up a bigger slice of the pie, while smaller companies take up less. This reduces risk and adds a layer of stability to your portfolio. Index funds are passive, but they do make occasional adjustments. For example, if a company in S&P 500 falls out of favor and is replaced by another, the fund will mirror that change. It's like your playlist is updating itself with the latest hits without you or any active professional lifting a finger. A quick note on pricing value. When you buy an index fund, the price you pay is based on its net asset value. And we're not talking about the management fees. We're talking about the actual value of that index fund. This is calculated at the end of each trading day, so you can't buy or sell them at real-time prices like individual stocks. And if you're someone who likes the flexibility of real-time trading, hang tight because this brings us to the last piece of today's video, which is ETF, or exchange traded funds. This is the cool flexible sibling of index funds. Think of ETFs as being almost identical to index funds, but with a few extra perks that make them more accessible for everyday investors. An ETF is again a basket of stocks, much like an index fund. In fact, most of index funds have an ETF version, and you can recognize them because their names often include ETF at the end. The main difference, ETFs are traded on the stock market just like individual stocks. This means you can buy and sell them throughout the trading day at real-time prices. Yes, unlike index funds where you must wait for the net asset value to be calculated at the end of the day, ETFs let you act in the moment, making them super convenient for investors who like more control. Why ETFs are popular? Here's why ETFs are often the go-to choices for retail investors. Number one, low barriers to entry. ETFs are incredibly accessible. You don't need a large sum of money to start. There's no minimum investment required like some index funds have. You can even buy fractional or whole shares of an ETF starting with as little as $5 or less if you want to. It's a perfect option if you're just dipping your toes into investing. Number two, real-time trading. ETFs let you trade throughout the day just like any other stock. You want to buy in the morning and sell in the afternoon? No problem. This flexibility makes ETFs ideal for investors who like to keep an eye on market movements or want to take advantage of price fluctuations, although you should be doing these type of stuff as a regular passive investor. Number three, fractional ownership. Just like index funds, with ETFs, you can own a tiny slice of some of the biggest companies in the world without needing to fork out thousands of dollars. For instance, instead of buying one expensive share of a major tech company, you can own a fraction of it through an ETF that includes that stock. Here are some popular ETFs that track the S&P 500 index. SPDR S&P 500 ETF Trust or ticker symbol SPY, and Vanguard S&P 500 ETF or ticker symbol VOO. For people like me who live in Canada and want to invest in these ETFs but also want to avoid currency conversion charges, we have the options like VFV, which is technically the Canadian version of VOO, and it's traded in Canadian dollars. All of these ETFs serve the same purpose to mirror the performance of S&P 500. Their performance is nearly identical because they are tracking the same thing. However, if you're comparing a US traded ETF like VOO with a Canadian traded ETF like VFV, well, that's not fair because currency conversion can cause differences in returns. ETFs combine the best of both worlds. Like index funds, they provide diversification and low cost, but they also give you the added flexibility to trade whenever you want, even with the small amounts of money. Plus, just like index funds, ETF allow you to reinvest dividends automatically and follow a dollar cost averaging strategy, making regular contributions over time regardless of market conditions. This reduces the impact of markets' ups and downs on your investment and build long-term wealth in a low-stress way. In essence, ETFs are like the ultimate starter kit for investing, easy to use, low cost, and highly flexible. Whether you are a seasoned investor or just starting out, ETFs are a fantastic option for building a diversified portfolio. As I always say, don't let social media scare you into thinking investing is complicated. Pick a broad market ETF, invest what you can, and set it on autopilot, and allow time to do the heavy lifting for your future financial stability. And hey, if you're ready to start investing but you want to know the ideal order to prioritize your investments, watch this video where I'll walk you through everything step by step. So let's jump over there and I'll see you soon.